Today, while most investors are distracted by headlines about equities, geopolitical noise, and currency fluctuations, something far more important is unfolding quietly in the precious metals market. Silver has surged to test near $89 and is holding firmly around $88, even as gold hesitates and broader risk assets struggle. That divergence is not random, and it is not temporary. It is a signal. And if you are serious about protecting capital or positioning for opportunity in 2026, you cannot afford to ignore what the market is communicating right now, because beneath the surface of price movement, institutional capital is rotating with precision, and silver is emerging as the focal point of that shift. Everything discussed here is grounded in real market data, positioning reports, intermarket analysis, and observable capital flows. There is no hype in the tape. When metals begin behaving differently from one another, professionals stop listening to commentary and start analyzing order flow, open interest, option skew, and correlation breakdowns. That is exactly what we are seeing. Silver has pressed into the upper $80 range, touched near 89 in recent sessions, and is stabilizing around 88 with notable structural strength. Gold, by contrast, after climbing above $5,100 per ounce, has entered a more uneven consolidation phase. That divergence is the beginning of a leadership transition inside the precious metals complex. Institutional traders track these transitions closely because allocation models respond in real time when relative strength shifts. The gold to silver ratio, which measures how many ounces of silver it takes to equal 1 ounce of gold, has compressed meaningfully. When that ratio falls, it means silver is outperforming. Historically, that compression signals movement away from purely defensive positioning and toward more opportunistic exposure within metals. What is driving this shift is not retail enthusiasm or social media narratives. It is measurable inflows into silver futures, exchange-traded products, and physical markets. Recent Commodity Futures Trading Commission data shows managed money increasing net long exposure in silver futures. Managed money represents hedge funds, commodity pools, and systematic trading advisors who allocate capital based on quantitative models and macro fundamentals. These participants are not reacting emotionally. They respond to risk-reward calculations. When they expand long silver exposure, while gold positioning remains stable or declines, it indicates that models are identifying superior asymmetry in silver at current levels. Risk-reward analysis compares upside potential against downside exposure. Silver has improved dramatically on this front because it rebounded approximately 18% from its 2026 low, demonstrating that lower prices were tested and decisively rejected. In trading terms, that rejection forms a successful retest and creates a structural support floor. That floor reduces perceived downside risk and increases confidence for institutional capital deployment. Gold's move above $5,000 was psychologically powerful, but its subsequent consolidation and mild pullbacks have created short-term uncertainty. When gold retreated nearly 1% on the COMEX exchange during heightened geopolitical tension and tariff uncertainty, it revealed selective demand at elevated levels. That selectivity, combined with silver's resilience, forms the foundation of a rotation trade. A rotation trade does not mean money exits the asset class. It shifts within the class toward better relative value. Capital is not abandoning precious metals. It is reallocating from gold towards silver. That distinction matters. It means the broader demand thesis for metals remains intact. Tariff uncertainty throughout 2026 has supported both gold and silver as safe haven assets. Gold's rally above $5,100 and silver's acceleration reflect the same macro backdrop, but silver's percentage gains from its trough have been stronger, signaling relative strength. Relative strength is one of the most reliable tools used by professional traders. Assets displaying persistent outperformance tend to attract incremental capital. Strength validates existing holders and pressures short sellers to cover, reinforcing momentum. This feedback loop, often described in market microstructure theory as a virtuous cycle, fuels sustained advances. Silver's stabilization near 88 after testing 89 reflects early to mid-stage development of that cycle. Importantly, euphoria is absent. An absence of euphoria is constructive because rallies driven by structural demand endure longer than those fueled by emotional excess. Structural demand in 2026 is supported by monetary conditions. Central bank policies globally remain accommodative relative to expanding fiscal deficits. Monetary uncertainty erodes confidence in fiat purchasing power and elevates demand for real assets. Federal debt levels continue expanding, and bond market participants are increasingly aware of fiscal sustainability risks. When bond investors diversify, precious metals provide liquidity and accessibility. Silver's smaller market capitalization amplifies this effect. The total above-ground silver market is a fraction of gold's size in dollar terms. Equal dollar inflows therefore exert greater proportional price impact. While that sensitivity can intensify declines during liquidation phases, during sustained inflow periods, it accelerates appreciation. Historically, silver has delivered larger percentage gains than gold in bull cycles for precisely this reason. The current bull market, which accelerated in 2024 and extended through 2025 into 2026, has seen both metals reach new all-time highs. Gold's breakout above $5,000 captured global attention and drew new participants into metals. Many, calculating position sizing at gold's elevated price, shifted focus to silver as a more accessible alternative with potentially greater percentage upside. This overflow demand dynamic has repeated in prior cycles and appears active again. Recently, the largest 3-week surge in both metals confirmed underlying momentum remains intact. The surge was fueled by renewed tariff concerns, evolving Federal Reserve expectations, and technical breakouts triggering algorithmic buying. Algorithmic systems now account for a significant portion of futures volume. When silver broke above key resistance levels, buy programs activated automatically, compounding fundamental inflows. Open interest in silver futures has expanded alongside rising prices. Rising price with rising open interest confirms new long positions are being established rather than merely short covering. That distinction is critical. Short covering rallies fade quickly. New long-driven rallies tend to persist. Simultaneously, exchange-traded fund holdings have experienced steady inflows rather than panic spikes. Steady inflows reflect deliberate portfolio allocation decisions, not crisis-driven fear. This suggests silver is supported by sticky capital, money unlikely to exit quickly during volatility. Sticky capital underpins durable trends. From a price action perspective, silver's ability to test 89 and hold near 88 without sharp retracement indicates base building at elevated levels. High-level consolidation absorbs supply. Sellers take profits, yet price remains firm because buyers match demand. When buyers absorb available supply at elevated prices, overhead resistance diminishes. The path of least resistance shifts upward. Silver's consolidation pattern reflects textbook plateau transition mechanics. For holders who endured recent volatility, this validates the thesis that higher prices are being accepted rather than rejected by the market. Physical market premiums reinforce this interpretation. Elevated premiums above spot indicate genuine demand from end users and physical investors willing to pay above paper price. That creates a structural floor beneath futures pricing. Meanwhile, the supply-demand balance shows persistent deficit. Annual demand continues exceeding combined mine production and recycling supply. A deficit market must draw down inventories, and inventories are finite. Visible stockpiles in major vault systems have trended lower in recent years without meaningful reversal despite higher prices attracting scrap flows. This inventory drawdown operates independently of short-term speculation. It reflects structural imbalance. No major new mining projects of sufficient scale to materially alter global supply have entered production. Mine development timelines extend 7 to 10 years. Therefore, the deficit condition is unlikely to resolve quickly. When declining inventories meet expanding demand from investment and commercial sectors, upward price pressure becomes mathematically inevitable unless substantial new supply emerges. The convergence of supply deficit, institutional rotation, technical momentum, algorithmic participation, sticky capital inflows, and monetary uncertainty forms a rare alignment. When multiple bullish drivers synchronize, price trends tend to extend further and persist longer than consensus expects. Silver's advance from its 2026 low to current levels near 88 reflects resilience supported by measurable data. The market is communicating through price behavior, positioning metrics, capital flows, and divergence from gold. And the message is constructive. The critical question is whether this rally is fear-driven or conviction-driven. Fear produces spikes and collapses. Conviction produces steady accumulation and durable structure. Silver's behavior today exhibits the characteristics of conviction, and that distinction will determine what comes next. Today, when you step back and examine the architecture of this advance, rather than just the headline price, the structure becomes even more compelling. Silver's rally is not dependent on a single class of participant. It is being supported simultaneously by institutional allocators, commodity trading advisors, retail precious metals buyers, commercial hedgers, and reserve diversifiers. That diversity matters, because when demand is layered across multiple segments, the market does not rely on one fragile source of support. If one category pauses, another can absorb supply. That overlapping demand base creates successive floors beneath price, and that layered support is precisely what we have seen during recent pullbacks. Each dip over the past several sessions has been shallow, brief, and met with buying interest at progressively higher levels. In technical analysis, higher lows define an uptrend. Silver has consistently printed higher lows throughout this advance, confirming structural integrity. Moving averages reinforce the message. Short-term averages remain above longer-term averages in bullish alignment. Earlier in the move, the 50-day moving average crossed above the 200-day moving average, forming what traders call a golden cross. Since that signal, the spread between those averages has widened. A widening spread indicates accelerating momentum. Accelerating momentum attracts systematic trend-following capital, and trend-following strategies control enormous pools of global assets. When signals align across short-term, medium-term, and long-term models, capital flows compound. Silver is currently benefiting from multi-time frame confirmation. That alignment reduces the probability of choppy, directionless trading and increases the likelihood of sustained advance. But technicals alone do not drive durable bull markets. They operate within a macro framework, and the macro framework remains supportive. Trade policy uncertainty continues shaping global capital allocation. Negotiations, adjustments, and policy recalibrations keep volatility elevated relative to historical norms. Elevated volatility supports demand for portfolio hedges. Silver's unique position as both precious metal and commercially relevant asset enhances its appeal within diversified portfolios. Unlike gold, which functions primarily as a monetary hedge, silver carries embedded economic optionality. It participates in industrial applications while retaining safe haven characteristics. That dual identity makes it attractive in multiple scenarios. If economic conditions weaken, safe haven demand increases. If economic activity remains firm, commercial consumption supports pricing. That blend offers portfolio managers flexibility. It also means silver does not rely exclusively on fear to advance. The optionality embedded in its dual nature is often underestimated, and markets frequently reward underestimated assets. Options market data provides further confirmation. Implied volatility skew in silver options favors calls over puts. When call option implied volatility exceeds put volatility, sophisticated traders are paying more for upside exposure than for downside protection. That skew reflects aggregate positioning from thousands of participants. It suggests the collective probability assessment favors continued upside movement. Commitment of traders reports add another layer. The commercial category, including producers and swap dealers, has not displayed aggressive hedging behavior at current levels. When commercials refrain from heavy shorting, it removes a major source of overhead supply. Without that supply cap, upward price movement faces fewer structural obstacles. Retail traders often focus exclusively on speculative positioning while overlooking commercial behavior. Yet commercial restraint at elevated prices is an important structural signal. Synthesizing data across futures positioning, exchange-traded fund flows, physical premiums, and options markets generates a high conviction signal. High conviction does not eliminate risk, but it increases probability weighting toward continuation. Monetary policy further strengthens the backdrop. Real interest rates remain suppressed. When inflation exceeds nominal rates, real rates turn negative. Negative real rates reduce the opportunity cost of holding non-yielding assets like silver. Opportunity cost is central to precious metals valuation. When investors earn little or negative real return from fixed income instruments, allocating to metals becomes relatively attractive. Inflation remains above target, and tightening policy aggressively in a fragile fiscal environment presents constraints. That dynamic sustains a supportive monetary environment for metals. Fiscal conditions reinforce the narrative. Persistent budget deficits require ongoing borrowing. Expanding money supply relative to the limited growth rate of precious metals supply creates a debasement dynamic. Over extended periods, currency debasement translates into higher nominal metal prices. Silver benefits not only from monetary expansion but from its existing physical deficit. When monetary tailwinds align with structural supply imbalance, price pressure compounds. This alignment has historically preceded significant bull phases in metals markets. Evaluating whether current levels near 88 represent exhaustion or continuation requires examining characteristics of blow-off tops. Blow-off tops feature parabolic acceleration, extreme speculative positioning, universal bullish consensus, and detachment from fundamentals. Silver currently displays none of those traits. The advance has been orderly. Positioning, while elevated, is not extreme. Skepticism remains present in market commentary. Fundamentals support pricing. Measured advances often extend further than consensus anticipates precisely because they lack exhaustion signals. Market psychology also favors continuation. Many investors who hesitated earlier now experience regret. Regret fuels demand during pullbacks. A buy-the-dip mentality, when supported by data rather than speculation, stabilizes corrections. Recent dips in silver have been absorbed quickly, consistent with regret-driven re-entry. For existing holders, steady price appreciation reinforces conviction and reduces emotional pressure to exit prematurely. Emotional discipline is frequently the most difficult component of investing. Constructive price behavior simplifies that discipline by rewarding patience. From a portfolio construction perspective, silver has demonstrated low correlation with equities during stress episodes. During recent equity weakness linked to tariff concerns and growth uncertainty, silver maintained strength and at times advanced. Modern portfolio theory values diversification through uncorrelated assets. Real-world performance during stress carries more weight than theoretical correlation matrices. Portfolio managers observing silver's behavior may reconsider allocation frameworks. Strategic inclusion expands the structural demand base. When assets transition from tactical trades to core holdings, demand becomes rules-based rather than discretionary. Core allocations receive periodic rebalancing inflows, independent of short-term headlines. Silver appears to be moving toward broader core inclusion within institutional portfolios. As more allocators adopt this stance, demonstration effects accelerate adoption. When early adopters showcase performance and diversification benefits, peers replicate allocations. This cascading adoption process can persist across quarters and years. Silver's performance over recent quarters builds an evidence base supporting structural inclusion. Each additional period of outperformance reinforces conviction. Looking forward, catalysts remain numerous. Escalation in trade tensions, shifts in monetary policy toward easing, further tightening of physical supply, and continued institutional adoption all provide potential upside triggers. Downside risk would require simultaneous resolution of macro uncertainty combined with aggressive monetary tightening, raising real rates sharply. Such a scenario appears structurally constrained by fiscal realities and geopolitical complexity. Therefore, probability-weighted analysis favors continuation over reversal. Professional capital seeks asymmetric setups where upside potential outweighs downside risk. Silver currently presents such a symmetry. At $88, price may represent middle-stage repricing rather than late-stage climax. The combination of structural deficit, monetary accommodation, technical alignment, and institutional rotation establishes a foundation for sustained strength. Market behavior today reflects accumulation rather than exhaustion. The market absorbs supply efficiently. Options skew favors upside. Commercial hedging remains restrained. Open interest confirms new long participation. Exchange-traded products attract steady inflows. Physical premiums signal tangible demand. Each data stream reinforces the same narrative. When multiple independent indicators converge, conviction strengthens. Investors must decide whether to interpret silver's resilience as temporary anomaly or structural shift. Evidence favors structural shift. The rotation from gold toward silver, the compression of the gold to silver ratio, and the persistence of demand across segments all point toward continuation. Silver's dual identity enhances resilience. It thrives amid uncertainty, yet participates in economic expansion. That versatility broadens its appeal. In uncertain environments, assets with flexible demand drivers outperform rigid narratives. Silver's narrative adapts. The current environment reflects neither panic nor mania. It reflects calculated positioning. Calculated positioning sustains trends longer than emotional spikes. Observing the tape, one sees higher lows, stable consolidation near highs, expanding open interest, favorable skew, and restrained commercial selling. Those are not characteristics of imminent collapse. They are characteristics of structural advance, and structural advances rarely conclude quietly. They evolve through stages of recognition, adoption, and eventual broad participation. Silver appears to be transitioning from recognition toward broader adoption. The question becomes not whether silver deserves to be near $88, but whether current levels are simply staging ground for the next phase. If structural deficit persists, monetary conditions remain supportive, and capital continues rotating, the answer becomes increasingly clear. Silver's behavior today is not erratic. It is methodical, and methodical advances are often the most durable. Today, the most important distinction any serious investor must make is whether silver's strength is being fueled by temporary fear or by durable conviction. That difference determines everything about sustainability. Fear-driven rallies are violent. They spike rapidly on panic headlines, volatility explodes, and once the perceived threat fades, demand evaporates just as quickly. Conviction-driven advances unfold differently. They build steadily. They consolidate constructively at elevated levels. They attract participation from multiple categories of capital. And they persist because the underlying thesis remains intact even when headlines shift. Silver's behavior right now fits the second description with remarkable precision. Look closely at the microstructure. Price advances, pauses, absorbs supply, then advances again. Pullbacks are shallow and brief. Volume expands during breakouts and contracts during consolidation. Open interest rises with price rather than falling, signaling new long creation rather than short covering. Exchange-traded products show steady inflows rather than panic spikes. Physical premiums remain elevated in multiple regions, reflecting genuine demand for metal rather than speculative paper exposure alone. These are not characteristics of a fragile move. They are hallmarks of accumulation. Accumulation phases often precede the most powerful legs of a bull market. During accumulation, strong hands build positions while skepticism remains present. The absence of universal bullish consensus is constructive. If everyone were already convinced, positioning would be extreme and vulnerability to reversal would increase. Instead, debate persists. Skeptics question sustainability. That skepticism provides fuel, because each incremental confirmation forces reluctant participants to reconsider and potentially allocate. The supply side continues reinforcing the case. The silver market remains in structural deficit, with annual demand exceeding mine production and recycling supply combined. Persistent deficits require inventory drawdowns. Inventories in major vaulting systems have trended lower over recent years and have not meaningfully reversed despite higher prices attracting some scrap flows. This means that even as price rises, supply response remains constrained. Mine development timelines span 7 to 10 years. No significant new projects capable of dramatically altering global output have entered production. Structural tightness therefore remains embedded in the market. At the same time, monetary dynamics continue to favor tangible assets. Real interest rates remain suppressed. When inflation outpaces nominal yields, holding non-yielding assets carries reduced opportunity cost. Fiscal deficits remain elevated, requiring continued borrowing and expansion of money supply. Expanding currency supply relative to limited physical metal supply creates a debasement dynamic that historically supports higher nominal prices for precious metals. Silver benefits from both the monetary argument and the physical deficit simultaneously. Institutional rotation from gold towards silver amplifies the effect. As gold surpassed $5,000 and entered consolidation, capital-seeking relative value migrated towards silver. The compression of the gold-to-silver ratio reflects that migration. Ratio compression historically accompanies phases where silver outperforms within the broader metals complex. And once relative strength is established, quantitative models reinforce it by reallocating incrementally toward the outperformer. Trend-following strategies operate on systematic rules. When signals align across multiple time frames, they increase exposure. Silver currently exhibits that alignment. Momentum, relative strength, moving average configuration, and open interest expansion all point in the same direction. When systematic capital and discretionary capital reach similar conclusions independently, trends gain durability. Portfolio construction frameworks also support sustained demand. Modern portfolio theory emphasizes diversification benefits. During recent equity weakness associated with trade uncertainty and growth concerns, silver maintained resilience and, in some instances, advanced. That real-world demonstration of low correlation enhances silver's attractiveness as a diversification tool. As portfolio managers adjust strategic allocations to include greater precious metals exposure, a structural floor of demand develops. The transition from tactical trade to core allocation is significant. Tactical trades enter and exit rapidly. Core allocations receive periodic rebalancing flows regardless of short-term noise. As silver becomes embedded in more institutional portfolios as a core holding, demand stability increases. Demonstration effects accelerate adoption. When early adopters report improved diversification metrics and performance contributions, peers replicate the allocation. Options markets provide further insight. Call skew persists. Traders are willing to pay premium for upside exposure, suggesting expectations of continued appreciation. Commercial hedging remains restrained. Without aggressive producer selling at these levels, overhead supply pressure diminishes. When supply pressure diminishes while demand remains layered and persistent, the path of least resistance remains upward. Of course, no market moves in a straight line. Volatility is inevitable, but volatility within a structural uptrend often creates opportunity rather than signaling collapse. The limited depth of recent pullbacks suggests buyers are waiting. Regret among those who missed earlier stages creates additional potential buying power during corrections. That reservoir of sidelined capital acts as cushion. Evaluating downside risk requires imagining a scenario where macro uncertainty resolves comprehensively, real rates rise sharply, fiscal deficits shrink dramatically, supply expands meaningfully, and institutional capital rotates away simultaneously. Such convergence appears improbable given structural constraints. Trade tensions remain fluid. Fiscal realities limit aggressive tightening. Mine development timelines prevent rapid supply expansion. Probability weighting therefore favors continuation over reversal. At current levels near $88, silver may represent a midpoint rather than an endpoint. Historical precious metals bull cycles have demonstrated that when structural deficits align with monetary debasement and institutional adoption, percentage gains can extend beyond conservative projections. Silver's smaller market size magnifies inflow impact. Equal dollar allocations exert greater price pressure than in gold. That leverage cuts both ways in extreme scenarios, but within sustained inflow environments, it accelerates appreciation. The psychology surrounding silver also differs from past mania phases. There is interest, but not hysteria. There is conviction, but not universal agreement. This environment often characterizes middle stages of a bull move. Early participants have been rewarded. New participants evaluate data and gradually commit. Skeptics remain vocal, which prevents complacency. That balance often precedes extended advances. The market continuously communicates through price action. Silver has communicated resilience. It tested near $89 and held firm around $88. It absorbed selling without material breakdown. It diverged positively from gold during consolidation. It attracted measurable institutional flows. It demonstrated technical strength across time frames. It maintained physical premiums. It operated within a structural supply deficit. It benefited from favorable monetary conditions. Each factor individually might be insufficient. Together, they form convergence. Convergence is powerful. When independent drivers align, probability increases. Silver currently sits at the intersection of supply constraint, monetary accommodation, institutional rotation, technical momentum, and diversified demand. That intersection is rare. Markets rarely offer such alignment without subsequent follow-through. For long-term holders seeking preservation of purchasing power, silver's setup reinforces patience. For traders seeking tactical opportunity, consolidation near highs with supportive data presents constructive conditions. For portfolio managers seeking diversification, real-world stress performance enhances allocation rationale. Across participant categories, the narrative remains coherent. This is not prediction based on hope. It is interpretation based on observable data. Prices, positioning, flows, and structure all indicate that silver belongs at current levels and potentially higher. The market is not whispering. It is speaking clearly through measurable signals. Today, silver is not merely reacting to headlines. It is advancing with purpose. Conviction underlies participation. Structural factors underpin pricing. Rotation supports relative strength, and adoption continues expanding. When the tape, the data, and the macro backdrop converge, ignoring the message carries its own risk. The story unfolding in 2026 is being written through collective action of global capital. That story currently reflects resilience, accumulation, and upward bias. Whether one chooses to participate is a personal allocation decision. But the evidence suggests that silver's strength is neither accidental nor fleeting. It is the product of layered demand, constrained supply, supportive monetary conditions, and strategic capital rotation. And when such forces operate simultaneously, trends tend to persist beyond initial expectations. Silver's journey from its low earlier in the year to levels near $88 demonstrates that the market has already repriced meaningfully. Yet repricing processes often unfold in stages. If the underlying drivers remain intact, further stages may follow. The question is not whether volatility will occur. It will. The question is whether the foundation beneath price is strong enough to absorb it. Current evidence indicates that it is. Silver stands today supported by conviction rather than fear, by structure rather than speculation, and by measurable flows rather than narrative alone. In markets, that combination is powerful, and when such power builds methodically rather than explosively, it often signals that the move is far from complete.